So now we are on to understanding the speculative demand for money. Just a quick disclaimer that before understanding what exactly is the speculative demand, we ought to be knowing what exactly the transaction balance and precautionary balance is. If you know, that is then well and good, and if you don't know, then please either read Freud or watch the videos that I have uploaded just before this one. So alright, let's get on to what exactly is the speculative balance. So Keynes was of the view that people definitely hold some money in the liquid form. I mean, money itself means liquidity. So people hold money just to carry out transactions or as a precautionary balance. Transaction means to buy goods and services, and precautionary balance means to meet any unforeseen circumstance. So for example, a medical emergency sort of thing. So apart from these two things, people also hold money just to be having some sort of benefit about the future changes in the rate of interest. As we know that money yields no income. As such, money is idle, it gives no interest rate, no income at all. Return on money is absolutely zero. But we know that if the same very money is invested onto buying bonds, then bonds yield some rate of interest. So just to get benefit of that very rate of interest and some future changes in that rate of interest, people will be some sort of undergoing some calculations that whether money is to be held in liquid form or it is to be spent somewhere. But whatever money is held in order to get benefited by a change in the future rate of interest, that shall be the speculative demand or speculative balance. It means that money will definitely be held in a liquid form per se, but not for carrying out transactions, not for undergoing any precautionary meat, but for getting the benefit of any future change in the rate of interest. And we shall be studying this thing in a detailed manner right now. The idea is that people are very, very calculative. So let's assume certain things. Number one, first assumption is that bond is a perpetuity. Right now we are just talking about the speculative balance, that is that some money has to be held by people so as to gain the benefit of future change in the rate of interest. So we have to make some sort of assumptions here. Number one, let's assume that bond is a perpetuity. It means that bond yields only a rate of interest, only a coupon payment, and its principal amount is not paid back. So let's say a bond market price is $1,000 and we get $50 as a payment onto it. So our interest becomes 50 divided by 1000 into 100, we get 5%. $100 principal amount, $50 is the coupon payment, and we get it as 5%. First of all, let's say that market rate of interest remain 5%. It means that there will be no change in the bond price because 50 divided by 1000 will get 5%. So we don't really need to change the denominator here. This is our case number one. Now let us assume that the interest rate in the market has gone up to 10%. Now what will happen to the bond price? This is pure maths. If we are to keep the coupon payment constant, that is $50, then the only way we can make 10% is by decreasing the denominator. So 50 divided by, we have to place something as denominator in order to reach at 10%. So 50 divided by 500 into 100 will get 10%. So what have we come across is that the bond price has gone down. This is one conclusion, that the moment interest rate has gone up, bond prices have gone down. Now bond is just like any other commodity. Today if you're buying something and after a year its capital value has gone down, it simply means that you have suffered a capital loss. This is plain simple. This is quite simple. Now moving on to the second thing, and let's assume interest rate has not gone up, rather it has gone down. So it was 5%, now it has gone down to 2%. Now in order to make this equation hold true, we have to place something at the denominator. So we'll just be needing to put $2,500 in the denominator so that we reach at 2%. So 50 divided by 2500 into 100 will get 2%. So it simply means that the moment interest rate goes down, our bond price goes up. So bond, as I've already stated, is just like any other commodity. Just for the sake of understanding, we are saying this, but again, bond is not a commodity. Bond is a financial asset, and we know financial assets are not as same as the real asset. But again, let's just not go into what exactly am I saying. We just have to go with the broad theme, with the crux, with the idea, underlying idea. Okay, so the interest rate has gone down, bond price has gone up. It means we have incurred a capital gain. This is quite interesting. 3 conclusions we have reached up till now. Number 1, bond is a perpetuity. It's not a conclusion, of course, it's an assumption, but I am just revising the thing now, that bond is a perpetuity. Coupon payment is $50, so $1,000 is the principal amount of bond and $50 is the coupon payment, and this way interest rate turns out to be 5%. Now if market interest rate goes up, we'll have capital gain or capital loss. We'll have capital loss, because we just have to memorize this conclusion that interest rate and the bond price, they are inversely related. And why are they inversely related? It is just a pure maths, as I've already stated. If you haven't got hold over it, then I would request you to please watch this again. So this is just a pure maths. Interest rate 10%, denominator has to be 500 in order to keep the interest rate as 10%, because 50 upon 500 will get 10%. So this is the conclusion. Please memorize this, because if you are understanding, if you are watching this for the first time, then this thing get very, very confusing. But again, we just have to be beyond these tiny details. These things have to be very, very obvious to the students of economics. So yes, interest rate has gone up, bond price has gone down, we'll have capital loss. Now we are on to a conclusion where we are seeing that return on money is 0. Pretty simple, quite easy. Money yields nothing. If you're keeping the money in idle form, we'll not be getting anything onto it. So return on money is absolutely 0. But we have some earning on the bonds, and that is our expected earning. We'll see what exactly is this thing, why we are using the word expected here, because interest earning is definitely there, 5% is there, but we are seeing that with the changes in the rate of interest, we'll be seeing a movement, quite inverse movement onto the bond price, and thereby capital gain or capital loss. And what exactly these things are, we're gonna be seeing this through a diagram also, and then this will become more clear. All right, now suppose that, okay, so we just need to understand few things here before understanding what these highlighted portions are. I'm sure what I have explained up till now is been pretty clear. I just kept on repeating myself, because I think a lot of explanation has to be done. One line explanation is not sufficient. So alright, this highlighted portion means that money demand comprises of, number 1, transaction demand, and number 2, speculative demand. As I've already stated, precautionary demand becomes a part of transaction demand. So M1 means transaction, M2 means speculative, and together if we add these two, we get total money demand. Alright, and what exactly is our total wealth? Money or bonds? We add these two, we get our wealth. Alright, now we just have to understand this diagram, and we really don't need to read anything. This diagram is quite self-explanatory. Onto the x-axis we have speculative demand for money. So this WH is our total wealth minus the transaction balance, we'll get the speculative balance. And onto y-axis we have rate of interest. Now Keynes is of the view that there is something called a normal rate of interest, that rate of interest that is bound to prevail in the economy, and that is quite normal rate of interest. For example, today also we know that the Monetary Policy Committee just tries to keep interest rate in the range of 2, and the range is +2 -2. It can go down to 2 again goes up to 6, so range is plus 2 minus 2 and 4. So this is something a neutral or normal rate of interest. So people also have their expectations about a normal rate of interest. So this is RIN. If the rate of interest is above this normal rate of interest, then people gonna be knowing that rate of interest is definitely bound to go down because it is above the normal rate of interest. And as I have already stated, rate of interest and bond prices are inversely related. If rate of interest is going down, it means bond price will go up. Bond price will go up, it means we'll have a capital gain on the bond that we are holding. What does this mean? It means that people's demand for money to be kept in an idle form, to be kept as a speculative balance, will be absolutely zero, because either way they'll be losing out on interest which they otherwise would have gotten by spending the same very money in the bond. Plus they will be losing out on the capital gain also that they will be getting by future changes in the rate of interest, that is future fall in the rate of interest, and thereby future rise in the bond prices, and thereby a capital gain on that very bond. So this is the reason, just as not to suffer any losses, people will not be keeping money in the idle form when the interest rate is above the normal rate of interest. This is one thing. Now beyond this normal rate of interest, towards the cursor I am moving on, above RIC but lower than RIN, here also the speculative demand for money will be zero. Why so? Because number one, people will be getting some sort of interest rate, and if they are not spending money in buying bond, they'll be losing out on that interest. Number one. Number two, the rise in rate of interest, people's expectation about the rise in rate of interest so as to reach a normal rate of interest is quite low. A small rise in rate of interest is needed to reach the normal rate of interest. A small increase in rate of interest means a small decline in the bond prices. That means a very limited loss on the capital asset, that is bond price. So either way, the interest rate that people are getting onto the bond is far more than the capital loss they would be getting by buying that very bond. Okay, so in this case also, the demand for money in the liquid form as a speculative balance will be low. Now moving on to the third point, and that is RIC, that is the critical rate of interest. As per Keynes, when the interest rate is RIC, I stands for individual here, because as per this book we are talking about an individual only. So RC is the critical rate of interest. At this very rate of interest, what is happening is the rate of interest is exactly equal to the future changes in the capital gain or loss. So not gain, it has to be loss, because we are far below the normal rate of interest. So if the interest rate is lower than normal rate of interest, it means in the future people are expecting it to go up. It means in the future people are expecting the bond prices to fall. It means people are bound to suffer losses, but the interest rate that the bond is offering is just equal to the capital loss that people will be suffering. So these two components gonna cancel out each other. So people gonna be really indifferent. They're gonna be no difference at all. Either they're gonna be spending the money in the liquid form or they're gonna be buying bond. It doesn't make any difference. So in this case also, the demand for money as a speculative balance will be zero, because the losses will be equal to the gains. Alright, I think this is enough of the explanation. So yeah, but if interest rate falls below this critical rate of interest, then definitely interest rates gonna go up in the future and bond prices gonna go down considerably, and they're gonna be very high capital loss. So if the interest rate falls below the critical rate of interest, people are gonna suffer heavily. So they're gonna be not investing that their money balance in the bonds, rather they're going to be willing to keep that very money in the idle form as a speculative balance. So speculative demand for money will increase drastically. This is it. So we got few things here, and these are very interesting, I would say. Again, Keynes is of the view that everybody has its own expectation about the normal rate of interest, which again is a very realistic assumption. Some people are quite bullish, some are not. So it's not like all's gonna have a same expectation about what the normal rate of interest in the economy. No, everybody is different, and so are their expectations. So in this very manner, we have drawn the speculative demand for money, which is inversely related to the rate of interest, which is downward sloping. I think I have already explained this enough. If I end up explaining it more, it would just be a repetition. Either way, you have to read the Freud, so things will get more clear. Alright. Further, Keynes is of the view that at a very low rate of interest, that is, let's say the rate of interest has fallen down to here. At a very low rate of interest, everybody would be of the view that now the interest rate is bound to go up. It means the bond prices are bound to go down. It means they're gonna be definitely incurring losses if they end up buying bonds now. So they're gonna be willing to hold whatever money they are being supplied as a liquid form. So their speculative demand becomes infinite, and this is what we call liquidity trap. That is a situation at a very low rate of interest when the speculative demand for money schedule becomes nearly horizontal. So people gonna be end up keeping the money with themselves no matter what amount of money they are supplied with, because their expectations are that in the near future interest rate is bound to go up, because at present it is quite low. So this is a situation where interest rate is very low and people are just into holding the money into liquid form, and this is what we call as liquidity trap. But let's just read the highlighted portion now. At this rate, that is at a very low rate, the increment to wealth, that is any additional money supplied, would be held in the form of money with no further drop in the rate of interest, and Keynes termed this situation as the liquidity trap. Right now, if you're not getting this point, that is with no further drop in the rate of interest, then don't worry. It would be enough for you to understand that at a very low rate of interest, this money demand schedule will become nearly horizontal. So interest rate will not fall further, but we'll delve into this thing when we talk about the money supply also in our next lecture, definitely. But right now I'm sure we have got a fairly clear idea about what exactly is the speculative demand for money, how we have derived the speculative demand for money schedule, and why is it downward sloping, why does it have an inverse relation with the rate of interest, and what exactly is the bond, how bond prices and the interest rates are related. So just go through it once again at a lower speed if you think I spoke very fast, and read the Freud, and then after just memorize the conclusions, because we are dealing with an exam and merely understanding things is not enough, right? Just memorize the conclusion that rate of interest and bond prices are inversely related. Bond prices, interest rate goes up, bond price goes down, capital loss, and vice versa. Alright, in our next very video we'll talk about the total demand for money, of course as a linear format, and whatever is there in the Freud we'll cover in our next video. Thank you so much for watching. Goodbye.